This conference will now be recorded.
I sent it to you.
Okay. We begin our discussion on Tuesday, about the accounts receivable. And we went through the accounts receivable cycle. We also look at depreciation, and we didn't get to, but we will today, look at stockholders' equity. And we said in the accounts receivable cycle, sales are made on account. And sales on account are fine, but they have to be collected. And so there can be returns, and then when you sell on account, people may not pay. So a number of things can happen on sales on account. So you should be familiar with the cycle. When a sale is made on credit, we debit account receivable and credit sales, type 15. But then we have to recognize any bad debts, because if we've got these sales recognized, that's going to be income. And so any related expenses need to be adjusted for, so that we're going to be paying tax on 40, not 600, if we're not going to get 600. When we determine, okay, when we make this entry, we don't know who's not going to pay. So we debit bad debt expense and credit the allowance for doubtful accounts. Okay, but when we have a customer who's purchasing goods costing $20,000, he says, okay, I'm filing for bankruptcy, you know who the customer is now. So you debit the allowance account and credit account receivable. You couldn't credit account receivable when you first made the entry because you didn't know who was not going to pay. But once you determine who those companies or individuals are, then you debit the allowance and credit the account receivable. So the allowance is just kind of a holding account until we can determine who's not going to pay. Then we credit that person's account. We said there were two ways to calculate the bad debt expense. One was the percent of credit sales, where you just take a percentage of credit sales, and that's the expense. No consideration is given to the balance in the account when that calculation is made. Then we have the account receivable aging method, where we age the accounts. And in this case, we aged the accounts. We had a bad debt percentage by age. It increased. The older the account was, the more likely it wasn't to be paid. And the amount turned out to be $85,000. But because we already had $15,000 in this account, we only write off $70,000, so we get it to $85,000. So the difference is that on the percentage of sales, we are not concerned with how much is in the account. We just take that percentage of the sales. So sometimes this matches better, but if this percentage is not where it needs to be, then we may not have enough in the account. So the allowance method allows us to go through and come up with a more realistic picture of how much in the accounts are bad. And as I told you, this is not the hardest of information to work with. So let's look at these multiple choice questions.
Okay, can I switch with the kids? Can the kids come out here?
Pardon?
Hmm?
Can you what?
What?
Okay.
This class.
I just wanted to say that it's my birthday today.
And our
President
first
Board,
question, yes,
are we about to go over it?
yes.
Oh, okay.
And the agent of accounts receivables indicate that 6,000 are estimated to be uncollectible. If the allowance for doubtful accounts has a 2,000 debit balance, what adjustment are we going to make to record the bad debts? A, B, C, or D?
I put B. Nope, that's not. It's not B.
That's not B.
Dang.
Is it C?
Debit to bad debt expense of 4,000.
Mm-hmm.
That's fine.
It's C.
Yeah.
How would you get 4,000? Oh, I see. Never mind.
Already has a balance of 2,000. And I guess D could be okay also because you credit the allowance for doubtful accounts for 4,000. So C or D. But remember, when we're using this method, we're going to see how much is in the account. However, it says it has a debit balance of 2,000. So it doesn't have a credit balance, but it has a debit balance of 2,000. So if that's the case, what do we need to do? It's actually A, because it doesn't have a credit balance, it has a debit balance. So because that balance is debit, we have to add it. So the actual answer is A, 8,000. Okay?
That's fine.
If
So
it
what's
were a
the?
credit balance, 4,000 would be correct. But because it has a debit balance, we want the balance to be 6,000. So the account at present has a debit balance of 2,000. So it's going to take a credit of 8,000 to get it to 6 where we want it.
So why wouldn't it be B? Excuse me.
Because you have to credit the allowance account.
So, question: if it's bad debt, it can be debit, not credit.
And all expenses have to be debited.
Okay, so that's included in bad expense. So the
So,
allowance account would be credit always.
right. So what this problem says is we look at this one. It says there's a debit balance of 2,000. Okay. So let's just take these out. And it says the balance is supposed to be what? 6,000.
6,000.
So what entry do we need to make so that we go from a debit of 2 to a credit of 6? What entry do we need to make? These are the accounts. How much money does it have to be?
Hold on, I lost it.
8,000. We need 8,000 credited in here. And now the account will have a debit balance, a credit balance of 6,000. Okay? All right, so just think about that one. When the allowance method for accounting of collectible accounts is used, bad debt expense is recorded when?
In the year after the credit is made. Dang it. No, the year of.
Should be in the year of the credit sale. D.
Yeah.
Should be number D. To record the estimated uncollectible accounts using the allowance method, the adjusting entry would be?
Your 401k or your 403b. And
Would that be A?
No.
God,
It's the same entry here. What did we debit?
Is it B?
Yes. What did we credit? The allowance. That's all the question was asking. Okay.
so that would be C. No, that would be B.
That'd be B.
Okay.
Number 4, using the percentage of receivables method and recording bad debt expense, estimated uncollectible accounts of 45,000. If the balance is 6,000 credit before the adjustment, what is the amount of the bad debt expense?
I pick B.
39,000.
Why'd you
That's what
pick B? So if we
I
go back
subtract
up
it.
here to this example, how much does it say is in the account? 6,000, right?
6,000.
And we want the balance to be what? 45,000. So we got 6,000 in the account and we want it to be 45. How much do we have to add?
39.
39,000. How y'all doing on these? I don't know.
I
I,
said B.
I did okay.
Well, I'm grading the whole class.
I
Okay,
don't get it.
but we'll see how many y'all got right. In 20X, Wilson had net credit sales of 2,250,000. On January 1st, the allowance for doubtful accounts has a credit balance of 54,000. During the year, 90,000 of uncollectible accounts were written off. Past experience indicates that the allowance should be 10% of the balance in the receivables. If the accounts receivable balance as of December 31st was 600,000, what is the required adjustment?
Oh, I didn't do that right.
You didn't do that right?
I don't think so. I put D. I don't think I did that right. Now I'm looking back.
I pick C.
Because
Why'd you put
90,000
C?
were written off.
Why'd you put C?
I had did I think the 54,000 and then subtracted it from the 10% and then I added the 2,000.
Okay. The balance is 600,000, right? So how much is supposed to be in the account?
600,000.
Well, in the receivables are 600,000, and so how much is supposed to be in the account? Let's go back up here. It's saying 60,000 should be here, okay? Now we need to determine what our balance in the account is. The allowance account had a credit balance of 54,000 and 90,000 was written off. So if 90,000 was written off, and the balance was 54, how much is in that account now?
6,000.
Now it says, no, we just, when we started the year, we had a credit balance of 54. Let's go up here and let's put the 54 right here. So it says this is 54. Let's take this off. And then it says we wrote off how many?
We
90,000.
wrote off 90,000.
Okay, so when we write the account off, that's when we debit it. That's when we know exactly who is not going to pay. So we started off with 54. We wrote off 90. And so the balance after the write-offs is 36,000, right?
Right.
What number we got to put in here to get this to be 60?
It's 24?
Would that work?
Yeah.
Yeah. We're trying to get from 36 to 60, right?
Yeah.
Yeah, 24,000.
So yeah, 24 looks like yes. I don't know if did we have that one available?
25.
Yeah, I guess that's close enough. So this probably should have been 24.
Okay.
Let's go on number 6. Tanning analyzes receivables to estimate bad debts. The accounts receivable balance is 300,000 and credit sales of $1 million. And aging shows that approximately 10% of the receivables will be uncollectible. What adjusting entry be made if the allowance for doubtful accounts has a credit balance of 2,000? What
So with
entry here?
$1,000 go on the debit side,
Say what? It's
with
on the
that
credit side. We got 2,000 on the credit side.
but what about the 300,000?
10% of those are gonna be bad.
Okay.
So going back up here,
Be A.
A is the correct answer because what? We had 2,000 in the account. We want it to be what? 30,000, 10%. So the amount of that entry would be 28,000 to get us there. And let's knock off this final one. JSJ Publishing utilized the percentage of sales method to estimate the bad debt. And the estimated uncollectible rate is 10%. The accounts receivable balance of 300,000 and credit sales are $1 million. And aging of accounts receivable shows that approximately 5% of their outstanding receivables will be uncollectible. What adjusting entry would Tanning make if the allowance account has a credit balance of 2,000.
B.
13,000.
Well, neither one of those right.
Dang.
My first guess was C.
It says we're using a percentage of sales method, and the rate is 10%. So all we had to do was take 10% of credit sales,
Right.
100,000.
That's 100,000. That was my first answer.
Okay, wait. Explain how you got that.
Say what now?
I need you to explain how you got that.
We just took 10% of $1 million.
Okay.
That's all we had to do. So there's other information we didn't need. It just put in that account and throw you off.
Wait, so what's the difference between 6 and 7?
Okay. In 7, versus 6. In 6, we're using the method where we look at the balance in the account. We age the accounts. When you age the accounts, you're going to look at how much is in the account, 2,000. But if we do percentage of sales, we ignore what's in there and just take 10% of the sales.
Right a knife here, and look what happened. Look what happened. Look at this, y'all. Watch this. Watch
So one method, go back up here again, is a percentage of sales. We're just going to take 10% of the credit sales, and we're done. We aren't concerned about what's in the account. We're going to use 10% of the credit sales, which in this case were 500,000. But if we were using the aging method, then with the aging method, we got to see how much was in the account and then adjust around it. So look over those.
Okay.
They aren't overly hard. The next thing we talked about was long-term assets and depreciation. We talked about long-term assets and depreciation. And we said that for current assets, they typically last a year and they're gone. But non-current assets, building, land, machinery, leases, leasehold improvements, intangibles, goodwill, trademarks, these items last more than a year. And with both land and with goodwill, we never write them off. We assume that they're going to be there forever. But all these other assets we depreciate because they're prepaid assets. They're just like prepaid insurance and supplies are prepaid. These are prepaid also. They're going to eventually have to go into the income statement, and revenue has to be generated. So that's why we should have made the expenditure. So, and we said that there are a lot of ways to calculate depreciation, but we were only going to look at straight line and declining balance. Then we use this example of how depreciation works. We said, assume you bought a car for $4,000 and it had a useful life of 4 years. And that car is depreciating with no salvage at the rate of $1,000 each year, straight line depreciation. So when you buy the car, you debit October for $4,000 in credit cash. And at the end of the first year, you record the decline in value by debiting depreciation expense and crediting accumulated depreciation for $1,000. The $4,000 cost stays on the books, but then this credit in this accumulated depreciation account lets us know that the net book value worth of the asset is $3,000. So we originally we're going to keep that cost, then we're going to create this accumulated depreciation account, and that's going to tell us how much is depreciated here. Year 2, we make that same entry again, but now, the auto is only worth 2,000. So going back to our example, another year of depreciation has occurred. Then on, and you see how this example works. It shows the auto getting smaller and smaller. So at the end of the 4th year, it's not worth anything. So what this kind of depicts is that, okay, you bought this car for your business. It's not going to be worth anything in 4 years. So you got to write it off as an expense, just like you would supplies, because it's being used up. And so the big thing, you need revenue to cover that cost. Any questions on that example? Then we're just using 2 methods, straight line, double declining balance. And let's just look at it through example. The asset costs 50,000, salvage is 10, life is 10 years. Whenever you're doing straight line depreciation, we list the cost, we subtract out the salvage. So the cost minus the salvage is what we're going to depreciate. We come up with a straight line rate, and this rate is simply 100% divided by the life of the asset. So to get this rate, we take 100% and divide it by the 5-year life. Wait a minute. I'm looking at this. I think this should be 10 here. What do you think?
What are we looking at?
Yeah.
It should be 10%, and this should be 10. So the life would have been 10. The rate is 100%, so it's just 10% or 10 into the salvage value. So 10% of the cost in the first year is 4,000. The accumulated depreciation is 4,000. Then the next year, another 10%, 4,000. Accumulated is 8. The next year, 10% is 4,000. The accumulated is 12,000. 10%, 16,000. Then at the end of the 5th year, 10%, 4,000 again. So the accumulated depreciation is 20,000. Any questions?
How you said, I got 10%, but I forgot how I found that.
Okay, let's look here. When you're trying to get that straight line rate,
Mm-hmm.
let's look over here. Went the wrong way. Can you see it better now? Can you see this?
Yes.
All we're doing here is dividing whatever the life is, which is 10 years. I don't know why this 5 came back up in here. We're dividing it into 100%. So to get your rate, it's just 100% divided by the life, okay?
Okay.
It's supposed to be 10. When we get the double declining balance, we divide the life by 200%. Okay, so we divide it by 200%. Yeah, that works out better. So the same process, sort of, except that we're not going to use the salvage. Now, we won't depreciate below salvage, but we're gonna base our depreciation on 50,000. But now it's gonna be the life divided into 200%. So it's twice the straight line rate. Our rate is 20%. So we take 20% of 50,000. Depreciation the first year is 10,000. Accumulated is 10. Any question on line 1 on the double declining balance? Any question? Okay, line 2. We got to get a new book value. It's always going to be the cost minus accumulated depreciation, which is what's in this account for the prior year. So now it's 50 minus 10, 40. We're going to take 20% of that number. So our depreciation the next year is 8,000. So whereas it's always 4,000 on the straight line, we start off very high and then it declines that's why it's declining balance. It declines each year. When we get to the third year, it's going to be 50 minus the 18,000. So that gives us 32 times 20%, 6,400. We add the 6,400 to the 18,000 and we get 24,400. So we have the 24,400. Get ready to go to the fourth year. We got to subtract that from the 50,000 to get 25,600. We take 20%, it's 5120. And so we just keep going through that process. So it's really a mechanical process. The balance that we depreciate goes down each year. The amount goes down each year. Any questions on double declining balance? So everybody can do that. So on your examination, you got to do a chart like this. Can you do it?
I had a question about that chart.
What's your question?
There's a noticeable difference between that chart and the one we were just working on, and it's this the book value. If the book value is not given, which book value do we use?
Book value is simply cost minus salvage. So we just had an extra. So we just, to show it probably easier. Let's put the 20,000 here. So we're just explaining that book value is cost minus salvage. Got it? So
I did that backwards.
And you knew that. Got it now?
Yeah, I did that backwards. I put the I put the book value on the salvage, and I didn't indicate what the salvage was. I left the book value blank for all of them, but I was putting the numbers that correlated with that under salvage.
The salvage is what's it going to be worth at the end.
Right.
What's our straight line rate going to be in this case?
20%. Because it's 20 years, right?
20 years. I don't think so.
Is it still 10%?
I'm going to take I'm going to take 100 and I'm going to divide it by 20. And that's 100%. So what's our rate going to be?
5%.
What's our rate going to be?
5%.
Anybody of these 18 people?
Yeah, I got 5% for that.
It'd be 5%. .05. So 5% is 0.005. Okay, 0.05. Everyone see that?
Yes.
So what's our expense going to be in the first year?
4,000.
What's our accumulated?
4,000.
We go to year 2, it's still going to be 80,000, right? That rate's going to stay the same. And this number's going to be 4,000. Again, but what's this number going to be?
8,000.
8,000. We go to the third year, 80,000 again. That rate stays there, so this is going to be what? 4,000. And now how much do we have in the accumulated account?
12,000.
12,000. So this especially is not the hardest thing to do. That's the straight line. What's our accumulated balance now?
16.
How much? How much?
16,000.
I guess you said 16.
Yes.
That's all it is. Any questions? All right, let's go to this one then now. So our cost is still 100,000.
Wait. I have a question. So the book value doesn't change for straight line? Is that just double declining?
Right.
Okay.
I guess it's more, this is probably a better term would be depreciable cost.
Mm-hmm.
This is probably a better term, depreciable cost. We're always depreciating 80,000. So that's probably a better term there. So the double declining balance, our book value that first year is always going to be its cost. What's our DDB rate going to be?
20.
20%.
How much?
20.
It's 10.
How much?
10.
10%.
10%. .1. Oh. How much is our expense going to be in the first year?
10,000.
And how much we got accumulated?
90.
No.
No.
That,
10,000.
when we get to the second year, the book value is going to be what?
It's gonna be no 90,000.
90,000. It's going to be the 100,000 cost minus whatever is up here, the row above it. Rate is still what, 0.1. So what's our depreciation the second year going to be?
9,000.
Accumulated?
19,000.
Move on to year 3. Still 100,000 here. What's our book value?
Would it be 78?
About 78. What's gonna go here?
1,000.
Would it be 78?
How do we get this number?
You
It's
subtract
cost minus
the
whatever's in this
depreciation
before.
from the book value.
It's cost, that's whatever's in this account when we begin from the prior year. So how much should be here? How much should be here?
81,000.
Thank you.
I said.
Say what?
I said that.
Did you? I didn't hear you. Sorry. Point 1 again. So what's our appreciation next year?
8,100.
100. How much we got in here now?
27,100.
Come here again. This is 100,000. How much is here?
72,900.
2,900. Rate still 0.1. So what's our expense gonna be this year? 7,290.
Mm-hmm.
What's our accumulated now? 34,390. Any questions? Any comments?
Can you tell me the equation again to get the book value for the next year after, the previous one?
It's simply the cost, book value, is gonna be the cost, that number over here, minus the prior, PRIOR, A/D. And A/D is this number here. Parentheses, A/D, shift parentheses. Okay. Got it? So it's whatever, when you get to this year, the prior year is new, so this is 0. But when we get to the second year, we go up here and see what's in this account and we subtract it. Got it?
Mm-hmm.
Wait, for the second part, the double declining, how did you get 10%?
We simply divide %200 divided by the life. Okay, 200% divided by the life.
Well, on number 3, when you got 81,000, we're subtracting 19,000 from 90,000 to get 81, right? But isn't that 71?
No, we're subtracting. We said cost. We didn't say
Okay, the cost.
Cost minus prior accumulated depreciation.
Okay.
Any further questions on the
No.
easy part of the test?
No.
Let's look at stockholders' equity for a second. And if you remember, we have the contributed capital and retained earnings. Then another term, treasury stock, we're going to discuss for a moment. When we form a company, we have to say what the shares are and what they're worth. So let's assume we say they're worth $100. If you get 150 for them, you'd actually debit cash, credit common stock, and then paid in capital in excess of the par value. These shares are pre-printed at $100. It costs money to change this, and you want them to be the same. So even though we've been debiting cash and crediting common stock, if we got more than the par value, which is 100,000, so they paid us 150 rather than 100, then this is the entry that's made. Sometimes companies will purchase their stock back, and they can't bother us, but they can debit treasury stock and credit cash. Why do companies buy their stock back? Because they'll have more, they'll have more of the income just left to them. So they're buying out other people and more money is left for them. So if you notice in the stimulus package, they wanted the owners of companies to pay employees, not buy back stock, so that they would benefit. So the way stockholder equity looks in companies, and you can have more than one type of stock, common or preferred, but it's the common and the shares outstanding. We bought back 10, so only outstanding is 90, but the outstanding is 100,000. What we paid in excess is 150. Our retained earnings is 200, so the subtotal is 350. And when we buy stock back, then that reduces it. So we show what we issued in total, but then we're going to show how much has been bought back. Now, sometimes the stock is bought back to give to employees, but a lot of time it's bought back so that the remaining shareholders, they'll have more value in the company. They'll get rid of some other people and they have more ownership. And so we don't want the stimulus money to be used this way, rather than paying employees and keeping the company going, they just say, forget about hiring people back. We can look good by buying out some shareholders and have less shares of stock. So that's what that discussion was about, treasury stock. This is what a stock certificate can look like. So when you put your money in the company, this is what you get, a stock certificate. And that shows that you own the stock. So once the money's in the company, it's there, and the board has decided to buy it back, but that doesn't happen. Okay. So we've done this. Done this. And let me see how you all coming. Let me see how you all are coming. Can y'all do a bank reconciliation?
Can we go over that?
I guess we will. Okay. So you will have a bank reconciliation, and let's just assume bank statement. Let me see if I can make one up that's a little simpler, because I only give the A students one like this one. Any A students in the house? They're all quiet.
Cricket.
Okay. Let's look at this problem here, and let's see what you can do.
I can do something if you stop moving it.
I'm trying to figure out the best way to do it. I have to figure out. Okay, so let's assume that we get the bank statement. I mean, we look at our accounts, and so this is what you will actually have. We get the balance, you know, we look at the bank statement. So let's look at the bank statement. So bank statement. So you get the bank statement, and it shows a balance and we'll make the balance $20,000. Okay. So the bank says your balance is $20,000. It gives you interest income of, let's say, $2,000. Let me tab over a little bit, 2,000 based on your, and service charge is $500. So you get the bank statement, the balance it has is 20,000. Before it comes to you. Then, before they mail it out, they make these adjustments. They add 2,000 for interest, they deduct service charges of 500. And so the balance that they're going to show is going to be how much?
21,500.
21,500. Okay. So next, let me just put it underneath. We come to the company. And for the company, when they look at their account, it has a certain balance, but there are outstanding checks.
Interest income is 2,000.
Well, let me do the deposit. Let's assume they have a deposit in transit. But they got a deposit in transit for $4,000. Okay. They also have outstanding checks which haven't cleared the bank yet. $6,000. Okay, so what I want you to do is to go up here and do the bank reconciliation first. So if you were going to do that bank reconciliation to the correct balance, so you all work on that. That is, you're going to use the information, and I just got to make a couple calculations on the company side to finish them up. But you work on the bank reconciliation now.
What does the company say its balance is?
I got to get that. You just up here. You got enough information to work up at the top.
Excuse me.
See if this number will work. We might have to work with it some. Let's see if 17.5 will work. I'm not saying it will. And so the company balance based on its deposit in transit and its outstanding checks. I'm not thinking the clearest today, but I'll try 19.5 anyway. We'll go back to it. So what you got to do is to move to the correct balance. In both situations. So let's go up into the bank. So we're going to go from the bank to the correct balance. We will start off with that balance for the bank, which is 21.5, okay? The bank has to pick up the deposit in transit. It doesn't have this deposit. So once it picks up the deposits in transit, it's going to add that deposit in transit of 4,000. So that's a plus. Then it's going to subtract the outstanding check. That's document bank display. And the outstanding checks, the one that have not cleared yet, are 6,000. So based on this, go back. The correct balance will be what? What's the correct balance going to be?
$19,500.
Okay, so let's see what the company's balance needs to be. We know that the correct balance now is 19,500. Okay, so that's what it's supposed to be. To get that balance, we're going to take the interest income that's on the bank's book, which is 2,000. Okay, then we have the service charge. And the service charge was 500. So the company doesn't have that. And therefore, the company's balance to get to 19.5, it'd be 21,000, 21, no. I guess be 18,000. So this should have been 18,000. So this company's balance should be in 18. So when we come over here, boy, there's a right way to work this one. We'll rework it in a second. So I'm saying that the company's balance is supposed to be, no, it doesn't go down right. The company's balance should have been 18,000. Then the interest would come in here as 2,000. So since you are thoroughly confused now, let me get in here and everybody except Terrell, a table.
I think I'm more confused than everybody.
Let me put it in a table format because this jumps around too much on me. Okay, so let me put this table in here. Let me undo it from there. Okay, so let's see if we can work it here. So a table will work with us. Okay, we have the bank state. Okay, so let's go back again. We have the bank. So here is the bank. And the bank says that its balance that it originally had was 20,000. So the balance before adjustments was 20,000. Then the bank put in some interest income. Of 2,000 because you had 20,000 in the bank. It had a service charge of $500. And so the final balance that came out on the bank statement was how much? 21,500, correct? Does everyone see that? So the bank, before it sent your balance out, It had 20,000. It gave you interest income of 2,000. It had service charges of 500 for special deposits and debit deposits and things like that. So the bank said its final balance was 21,500. Any questions? Let's go over here for the company. And so for the company, when it looked at its records, its balance was 18,000. So the company says it has a balance of 18,000. But there are some items that the bank doesn't have. And so one of those things would be deposits in transit. So there's a deposit in transit. There's a deposit in transit that we said was 4,000. Then there are some outstanding checks. And so the outstanding checks we said were how much? 6,000. So any question? Any question?
Yes, my question is, are you going to upload this to YouTube as well?
Yes.
And the last class that we had as well?
I think that one might be there already.
No, I couldn't see that one, the last class period that we had.
You couldn't see it?
Well, yeah, I didn't see that one because that's where we started using this document.
Correct.
And I didn't see it.
I thought it was there. We reviewed and we did it. So go through and, you just have to, we reviewed and then went on to this. So you might just have to go through and I think it's there. Just go through and skip parts of it, okay?
Okay, thank you.
You're welcome. Okay, so when we get ready to do a reconciliation, the bank says it has a balance of 21,500, okay? But the bank has to pick up these items to get to the correct balance, okay? So when we get ready to do the reconciliation, the bank starts off with its final balance, which it said was 21,500. It is going to add the deposit in transit. So a key thing is when we're doing this reconciliation, the bank has to go over here and get these items that it doesn't have. So that's going to be 4,000. Then it's going to get the outstanding checks. It's going to take those outstanding checks, which is $6,000, and it's going to subtract those. And so the correct balance based on adding this deposit in transit and subtracting outstanding checks is going to be what? 19,500. Okay. So final balance, their final balance was 21,500. They did not have the deposit in transit, and they did not have the outstanding checks. So the correct balance is 19,500. Now, once we have a correct balance, when we get ready to get on the company side, so go through merge cells. Okay, so here we have the reconciliation. So we have their balance, then the reconciliation, they have to pull things over here. Now, for the company, well, first of all, we know that the correct balance that the company has to have is that same 19,500. Okay. But the company has to come over here and it's got to pick up the interest income because it doesn't have it. So that interest income that the bank gave them, $2,000. Then they don't have the service charge. So it's sort of a crisscross thing. We reconciling these items over here. We reconciling these items over here. So the service charge. And that was $500. Okay. So if the balance that we had on the books were 18, and then if we added 2,000 for that interest and subtracted out 500 for the service charge, we'd be at 19,500, the correct balance. So look at this. Like I said, I'll take this, well, I'll record it and put it up and everything. You know, not a major type of deal, but just realize that these adjusting items on the bank side, they come over here for the company to be reconciled. The adjusting items on the company side, the deposits and transit and outstanding checks, they come over here for the bank to reconcile its balance so we can get to the correct balance. So think about that. I think we had one other exercise like that. It's not a major amount, but all you're going to have are interest income, service charge on the bank side, deposits in transit and outstanding checks on the company side, and you're going to be expected to get to the correct balance, okay? And finally, statement of cash flow. Remember, we scratch out everything that's not a cash expenditure, and then we fill out this chart. Journal entries 1 through 6 are going to be on the source side. Journal entries 7 through 10 is on the use side. So review 1 through 6 and have your template there, as well as 7 through 10. And fill this out to come up with the change in cash flow. You got the example of that. So it'll be exactly like that. If you need any help, just check with Tara. Any questions?
So the test is going to be over bank reconciliation, accumulated depreciation, straight line, and double
declining balance.
Cash flow statement. And
that's it.
That's it?
Well, you have some theory questions, about 5 multiple choice on theory.
Okay, theory. Oh, from the theoretical framework?
Correct.
Alrighty.
So you all have a good weekend. And I'll have office hours on Monday at 1. So if we need to review bank reconciliations or the statement of cash flow, we can do that at 1 on Monday. It's probably a good idea. So I'll have a better example thought out for the bank reconciliation. I would have already had it worked out. So we'll go over that, and we'll go over statement of cash flow on Monday. And depreciation if you need it, but you shouldn't really need it for that. Okay?
Okay, thank you.
You all, and let's give a shout out to Tara. Thank you for helping us get the YouTube up and going.
Yeah.
So, tell them thank you.
He gone.